Welcome back to Smart Stock Sam, where we find the setups before the crowd even knows they exist. Today we are breaking down HIMS and HERS Health, and this one is loaded. We have got a stock that just rebounded hard in a relief rally, a short squeeze that could be coiling up like a spring, and a bull run potential that has traders genuinely divided. We will walk through the full chart breakdown, the institutional money war happening behind closed doors, the options flow signaling pure aggression, the risks that could derail everything, and the exact levels you need to be watching. Buckle up, because this one does not sit still. Here is the first thing you need to accept about HIMS before we go any further. This is not your grandfather's healthcare stock. This is no longer the quiet, steady disruptor mailing out affordable prescriptions and growing subscribers at a comfortable pace. As of right now, HIMS has fully crossed into high-volatility momentum trade territory, and the reason comes down to one massive pivot. The company has shifted from selling high-margin compounded medications to distributing FDA-approved branded GLP-1 drugs, think Wegovy and Ozempic, through fully regulated channels. That single strategic move rewired how this business generates profit. And when you stack a business model transformation on top of a short interest above 40% of the float interacting with heavy daily volume, you are not lighting a match, you are standing next to an open gas line. The upside potential here is real, but if you step into this trade without tight risk controls, you are not investing, you are rolling dice. So let's look at what the chart has actually been doing. This chart tells a story of absolute devastation, and then, just maybe, survival. From a 52-week high zone between $66 and $70 per share, HIMS got completely dismantled, falling 70.6% to its recent lows. Even after the excitement of recent sessions, this stock is still underperforming the broader year-to-date market by 41.8%. That is a brutal number for anyone who has been holding this name. But here is where your attention needs to sharpen, because the short-term picture just did a complete 180. In the last single month, HIMS surged 33.47%, and after tagging an intraday low of $18.64, it snapped back with a 10.54% single-session rebound. So now every trader is staring at the same question. Is this a dead cat bounce that fades back into the abyss? Or is this the actual floor setting up a multi-month recovery? Could this stock actually never see $18 again? To answer that, we have to look at what changed inside the business itself, because the math is not the same anymore. This is the before and after that has Wall Street completely split down the middle. In the previous era, HIMS was a high-margin disruptor with a clear identity. They were the low-cost provider selling compounded semaglutide with EBITDA margins sitting at a healthy 13.5%. Investors loved that story. But as of March 26th, a new chapter began. HIMS pivoted to regulated distribution of branded Wegovy and Ozempic, and while that protects them from regulatory heat, it is an undeniable margin killer. EBITDA margins are now projected to compress down to 12%, and they have gone from being the affordable option to being an average cost provider at $149 a month, before you even add the cost of medication. Analysts at Bank of America and TD Cowen are already warning that this pricing shift could steadily chip away at their competitive edge. The math is straightforward and unforgiving. If HIMS cannot replace every dollar of lost margin with a flood of new subscribers, the investment case starts cracking at the foundation. And when you see what the biggest institutions on Wall Street are doing with their positions right now, you will understand just how divided the conviction really is. This is where the story gets genuinely fascinating. We are watching an institutional tug-of-war play out in broad daylight. On the sell side, JPMorgan Chase did not simply reduce their exposure. They nearly torched their entire position, cutting their stake from 8.1% all the way down to 1.7%. That single move triggered an immediate 4% drop in the share price. And the insiders are not exactly stepping up to buy the dip either. Over $3.4 million in shares were sold by company insiders in just the last 90 days, including the CFO offloading shares at prices well above where the stock trades today. Now, is there any chance JPMorgan quietly starts rebuilding that position while the stock is beaten down? Stranger things have happened. But here is the other side. SG America's Securities actually increased their stake by 25.6% recently, and total institutional ownership is holding steady at 63.5%. Even that alarming headline about Vanguard showing 0% ownership turned out to be nothing more than an internal subsidiary realignment, not a real exit at all. Smart money is genuinely conflicted, but the technical indicators? They are starting to point in one very clear direction. Let the math do the talking here. The signals are flipping. Starting with the RSI, our momentum thermometer for overbought and oversold conditions. It is climbing back from the danger zone and pushing toward 59.5. That is a bullish slope, and it still has meaningful room to run before hitting overbought levels. Now shift your eyes to the MACD. The positive slope curving toward negative 0.05 is telling us that the sellers are running out of fuel. The downward pressure is waning fast. But the single most important level on this entire chart right now is the 50-day simple moving average, sitting at $20.69. The stock is testing that line at this very moment. Hold above the 50-day, and a massive technical gap opens toward the 200-day moving average, which sits all the way up between $36 and $40 per share. That would represent a near doubling from current prices. Could HIMS actually reach its 200-day average before the year is out? The technicals say it is possible, but technicals are just the map. The engine that could actually drive us there is the single most explosive metric in this entire analysis. This is the big one, 40.16% short interest. Sit with that number for a moment. Nearly half of all tradable shares are currently borrowed and sold short by people actively betting this company craters. Here is what that creates. When a stock with this level of short interest starts moving up, even slightly, those short sellers do not calmly walk to the exit. They run. They are forced to buy back shares to cover their losing positions, and that buying pressure creates more upward movement, which forces more covering, which creates even more buying. It becomes a self-accelerating loop that can move a stock violently in a very short window of time. And with only 3.74 days to cover, meaning there is not nearly enough daily liquidity for all these shorts to unwind simultaneously. If HIMS clears its immediate technical resistance, we could be looking at a price move that catches the entire market off guard. This is the coiled spring, and the options market? It is already betting the spring releases. The options floor is not whispering bullish, it is shouting it. The current put-to-call ratio sits at 0.25, meaning call buying is outpacing put buying by a full 4-to-1. That is a remarkable level of directional conviction. Traders are aggressively loading up on the $18.50 calls expiring April 10th, which have already exploded 111% in price. That is not cautious hedge behavior. That is a bet placed with full conviction. Now, there is still defensive hedging sitting at the $15 put level, and implied volatility is running at a massive 92.8%, signaling the market is bracing for extreme swings in either direction. But the net posture of speculative money is firmly and aggressively bullish. Could we see options traders who bought these calls turn a 400% return before expiration? The setup is there, but first, you need to see the iceberg sitting just below the surface of all this excitement. None of the bullish thesis is worth a single cent if we ignore what could blow it up, and there is plenty that could. HIMS is currently under active securities fraud investigation from multiple law firms, including Shaw Law and Braunstein, Gewertz and Grossman, probing whether the company misled investors about the legal risks tied to their old compounded drug business. If those investigations evolve into formal class action suits, the selling pressure could arrive fast and without warning. Then there is the valuation problem. HIMS is carrying a price-to-earnings multiple of roughly 33 to 40 times earnings, a premium that demands flawless execution. Any stumble in subscriber growth or any further margin compression, and that multiple gets repriced harshly. This is the friction standing between the current setup and a full momentum breakout. Respected, but here is something working in the bull's favor that even the skeptics cannot ignore right now. The broader market environment is handing the bulls a meaningful gift at exactly the right moment. Reports of de-escalation and geopolitical tensions, particularly around the Iran situation, have triggered a significant risk-on rotation across markets. Capital is actively flowing out of safe haven assets and rotating directly into volatile technology and healthcare equities. HIMS is sitting right in the path of that capital flow. And when an entire sector catches a macro tailwind, even the most complicated stocks can get swept up in the momentum. The tide is rising. Whether it lifts HIMS all the way to those upper targets depends on what the trade setup actually confirms. And here is exactly how to read it. Here is the blueprint, and this distinction matters enormously. For the short-term trade, two confirmation signals need to hold: volume expansion breaking above the $21 psychological level, and the put-to-call ratio staying below 0.50. Both conditions met means the squeeze is live. For the longer-term investment case, the bar is higher and harder. HIMS must grow its subscriber base well beyond a current 2.5 million baseline to offset those compressing 12% margins. And they need full regulatory clarity before this transitions from a momentum trade into a conviction hold. Until the FDA dust settles and the legal probes close, this remains a trade first, fundamentals second name. Now let's get to the levels. For anyone looking to build a position, the recommended entry zone sits between $19.50 and $20.75. Getting in here lets you anticipate the breakout while still maintaining a logical stop below your entry. But if you prefer to wait for the structure to fully confirm before committing capital, the decisive long signal is a clean daily close above the $21 intraday high. That is your line in the sand. Above it, the setup shifts meaningfully in the bull's favor. Here are your key levels. Know them cold. Current price, $20.76. Directly overhead, immediate resistance clusters between $21.38 and $21.59. A dense zone of converging trend lines and moving averages. Punch through that, and the next major ceiling sits between $22.87 and $23.10. On the downside, your primary support is the March 30th swing low at $18.78. Lose that level on a daily close, and your last line of defense before the structure deteriorates is $18 flat, where heavy options activity creates a natural gravitational floor. These levels are not suggestions. They are your decision points. Before I give you targets of the trade, I want to give you an important reminder like always. Nothing in this video is financial advice. Everything you have heard today is purely for educational and informational purposes only. Always conduct your own research, understand your personal risk tolerance, and consult a qualified financial advisor before making any investment decisions. Markets can and do move against even the best-looking setups. All right, here are 3 targets, cleanly defined. Target 1, $21.80. The declining 50-day simple moving average acting as a magnet on the first leg of any move. Target 2, $23 even, aligning directly with Bank of America's stated price target. Target 3, $25, the average analyst target from firms including TD Cowen, and where the full short squeeze scenario reaches its logical near-term ceiling. On the risk side, your hard stop for a disciplined tight trade is $18.20. If you carry higher risk tolerance, you can push that floor to $17 flat, but not a cent lower. The moment this trade breaks structure, you exit. A momentum trade that turns into a bag hold is not a strategy, it is a mistake. So here is where everything lands. HIMS is a high volatility momentum play, not a stable buy and hold investment. The catalyst is that massive 40% short interest, with a genuine squeeze trigger sitting at a daily close above $21.80. The friction is margin compression from the branded GLP-1 pivot, compounded by live legal investigations and a demanding valuation multiple. And your personal mandate is simple. Size your position responsibly. Know your stops before you enter, and never let a trade become an emotional attachment. Lastly, here is what I want to know from you. Do you think this short squeeze actually fires and HIMS never trades below $19 again? Or does this relief rally fade and we retest the lows before any real recovery begins? Drop your answer in the comments right now. I read every single one. If this breakdown added value to your day, hit that like button, share it with someone who trades momentum setups, and make sure you are subscribed to Smart Stocks Sam so you never miss a breakdown like this one. I will see you in the next one.